Okay, thank you. Good morning and welcome to today's webinar. My name is Anna and I'm with the New Mexico Small Business Development Center. Today we have Tommy Thompson joining us, who's a SCORE counselor who specializes in business and corporate financial planning and business valuation. Tommy will be presenting Cash is King, cash management for your small business. We will be using the Q&A function to take questions and welcome attendee participation, so don't hesitate to ask us any questions you may have. We'll answer questions during and at the end of the webinar. There are some handouts which accompany this presentation. I'll send those links through to you via the chat function. Thanks so much for joining us, and without further ado, I'll hand it over to you, Tommy.
Anna, thank you very much. Good morning, everyone, and welcome. This is Cash is King, cash management for your small business. My name is Tommy Thompson. As Anna said, I'm a SCORE certified small business mentor. I also get to put a lot of letters after my name, CPA, MBA, all of that jazz. I spent my career mostly as a corporate financial planner, advisor, consultant, troubleshooter, and financial executive. I've got a lot of experience in keeping businesses afloat, including small startup businesses. And we've developed this seminar to help you do the same thing for your small business. Your audio is already muted. If you would, please make sure to set your Zoom ratio in your Zoom menu to fit window. That will fill your screen and allow you to see the largest possible typeface that we're using here. Some of the numbers that we're going to have for some of the examples are kind of small. We'll be using the Q&A function to take questions, as Anna said. Write down your question and write the related slide number down with the question so we can get back to that slide to address your question. We'll answer questions as they come up or at the end if we don't get quite to them at the moment that you write them down. So thanks much for participating, and we look forward to seeing questions and things. Today, what we're going to talk about is we're going to talk about some of the resources that NMSBDC has, including training offerings and consulting assistance. We're going to talk about what we want you to learn today, the objectives of what today's program are all about. We're going to talk about today's program, which is cash flow management and some of the related record keeping that's necessary if you take advantage of many of the pandemic programs that are out there. We're going to answer all your questions, and we're going to talk something about next steps. These are steps that you can take today to get going on managing the cash for your business, because you have to understand that cash is king, and we'll talk about that and why that is in a minute. Training offerings and counseling assistance are available from the New Mexico SBDCs. They're located in various places around the state, and their overall website is nmsbdc.org. You can go there to find other training offerings for cybersecurity, pandemic response, and a variety of other topics. You can also use the resources on that site to request no-cost business counseling and loan application assistance. So very useful site, nmsbdc.org. Today, what we're going to talk about is cash flow. First of all, what is it? What makes it flow through your business? We're going to talk about strategic cash flow principles that you should be keeping at the top of your mind all the time. We're going to talk about forecasting cash flow as a tool to get information that helps you communicate with the stakeholders in your business about your cash flow. And yes, you have to communicate. Then we're going to talk about some tactical cash flow management tools, practical things that you can do that will help speed up your incoming cash and make sure that your outgoing cash doesn't go out any sooner than it needs to. Finally, we're going to have a few words about record keeping requirements for the pandemic relief programs that are out there, some of which I hope you'll have taken advantage of by this point. And that is where we're going to be going for the day and those next steps that we just mentioned. Now, what you have to realize in the business, cash is king. It's the lubricant that runs your business. It makes exchanging one form of goods and services for another form of goods and services all possible. And the problem with that is that when you run out of cash, you don't have that lubricating fluid anymore and you crash as a business. Because the cash that makes your business work enables you to satisfy your creditors, enables you to operate, to buy groceries for yourself. So it enables your employees to buy groceries. And all of that is connected to smoothing the flow of business from one part, your customers, to the other part, your stakeholders. Now, what is cash flow? I kind of like Yogi Berra's definition, and they pay in cash, which is just as good as money, because that's what it is. Cash is money. It's the medium of exchange that equates the value of one side of a transaction with the value of the other side of the transaction. In a more formal sense, cash flow is the net amount of cash and cash equivalents, that stuff that is just like cash, being transferred into and out of a business. Now, notice it didn't say anything about profitability there. It's just cash coming in and going out. At the most fundamental level, your company's ability to create value for you, your shareholders, and your stakeholders is determined by your business's ability to generate positive cash flow and over a long term to maximize what we call free cash flow. Free cash flow is cash the business doesn't need to keep operating at a specified level of activity. Okay, that free cash flow can be reinvested in the business to make more, or it could be thrown off to shareholders to help them buy their boats and yachts and airplanes and things like that. But that's the key. It's cash flow, not profitability, that drives the value of a business. And you want to remember that and keep it in the top of your mind as you go along. Now, what goes into cash flow? What makes cash flow into your business? First of all, it's cash money coming in. Sounds obvious and simple, but it's more than just the cash that comes in from your customers. Yeah, that's part of it. Cash sales over the counter, collections on your customers paying their bills each month, deposits from customers for future service, prepayments of orders that they want to get from you. That's all part of profitability eventually, but it isn't necessarily timed the way profitability is measured. Okay, so you have to keep in mind we're talking just about the cash part of it. If you collect a bill today that somebody gave rise to 2 months ago, well, you measured the profitability of that 2 months ago, but you measure the cash today. So you see the timing difference? Also, cash can come in from government programs in these pandemic times, pandemic relief loans and grants, the payroll protection program you may have heard of, the economic injury disaster loans administered by the SBA, the state of New Mexico grants, the shuttered venue operator grants, the city of Albuquerque economic relief grants. All of those are cash coming into your business. Those particular ones might not start out as part of profitability, but they still are cash coming into the business. Also, and most of us are more familiar with this, bank loans, the cash from a bank loan coming into the business isn't part of profitability, but it is cash. Similarly, if you sit down and write a check to your business to loan it money or to make a further investment in it, that's cash, not part of profitability. Money from family, friends, and fools. Okay, those monies coming into your business may give them a stake in your business, but it's not part of profitability, it's cash. Similarly, cash money going out goes out not just for things that talk to profitability, but also for other things that draw on your cash that aren't part of profitability. Compensation, benefits and taxes, payments on accounts payable, rent, operating expenses, those are all things that are eventually measured in your profitability, but the timing of when the cash moves may be different from when we measure profitability. Similarly, bank loan repayment, capital equipment, owners draw, family and friends and fools money going out of the business isn't necessarily part of profitability, but it is cash leaving your business. So as you can see, there's more sources of cash and more uses of cash than just what goes into that profitability measure. Now, there's some things that aren't cash flow. Anytime you sell or buy on credit, I'll pay you tomorrow for a hamburger today. Remember Wimpy? Okay, I'm dating myself, obviously, but anytime there's a timing difference between when the profitability happens and the cash moves, you have a difference in cash flow. So your sales on credit, your accounts receivable invoices going out the door, they're not cash flow. The payments on them coming in a month later usually are. Similarly, purchases on credit. You get goods today, you pay for them next month. That's not cash flow today when you buy today in exchange for a payment promise later. That's a timing difference. And we'll talk about those timing differences more in a minute. Now, what's the strategy? First of all, your basic cash flow strategy is to work at it. This needs to be as top of the mind to you as servicing your customers and as building relationships with your creditors. You have to have it top of mind. You have to be always thinking about what does the impact will this have on my cash flow? How do I improve my cash flow? How do I slow down the cash coming out? Now, to do that, we need some information. We need some funny idea about when the cash is going to come into the business and when it's going to go out. We need that before we can do anything else, because we need a window into the future. We need a window that's basically art informed by science to the extent possible, but based on assumptions that we believe are reasonable about when cash is going to move into the business and when cash is going to go out of the business. Once we have that forecast, now we need to track it in real time. We need to track it as it's happening. All right. For most businesses, that means tracking it every month. We'll talk about that and some alternatives later. But you need to track your cash flow so you can compare it to your forecast, so you can verify or revise your assumptions. I think I'm going to get 70% of my customers to pay me in 1 month. Well, over 3 or 4 months, it turns out that 60% of your customers pay you in 1 month, 30% pay you in 2 months, 5% pay you in 3 months, and 5% never pay you. Well, that's one assumption. That gives you the information, the tracking, real-time data to revise your assumption going forward. Because when you create a cash forecast, you don't create it once. You create it and then create it again. You update it again. I tell my clients at SCORE to create a 12-month rolling cash flow. Every month you forecast the 12th month again, so that you have a window out into what's happening. And it's not just that 12th month. If you revise an assumption, it revises, you need to revise it for all of your months in between. Okay. So you got to forecast it, track it, revise your forecast. With that information, you can see into the future when you're going to have excess cash, the situation we all hope for, and when you're going to need cash because of business expansion, capital equipment purchases, you name it. And you can use that information then to plan how you're going to meet that cash flow challenge. Okay. And then what you want to keep in mind is I want to accelerate my cash in to the greatest extent possible, consistent with good business practices. And I want to slow down my cash out. Now, you'll notice I put a question mark after slow down cash out. That's not a typo. How do you do that? It's easy for me to say, but we'll talk about some ways to do that tactically as we go along here. But the basic strategy, work at it, forecast it, track it, keep it top of mind, revise your forecasts going, and then apply techniques to accelerate your cash coming in and slow down your cash going out. That information you get from your forecast and tracking lets you communicate with people, and it lets you be seen as a confident, competent businessman, because you're not just reacting to what happens to you, you are taking control of your business and actively managing what's going on. Now, let's start with forecasting. Forecasting talks about the question of where is it coming from, why, when is it coming in, where is it going out, why and when, and what is my cash position at the start and the end of whatever period that I'm forecasting. Okay, what's my cash right today? What's coming in to add to that cash? What's going out to subtract from it? And finally, when I add those three together, what's my cash at the end? And this is important because your cash flow may differ month to month to month. You may have a highly cyclical business. In the 1980s, I worked for a company called Gardenway Manufacturing. We made what was known in the East as the famous Troy-Bilt rototiller. You may have heard of it out here as well. And that was a big piece of outdoor power equipment, but it was a very, very seasonal product. From late February until mid-May, cash from selling these things would just flood into the business. But then we had to live on that flood of cash all the rest of the year till the next seasonal spike. Oh yeah, we had a little seasonal spike in September and early October when we sold tillers to people who were, getting ready to prepare their gardens for winter and things like that. But generally, the big flood was late February, March, April, and May. And we published a daily cash flow, what we called a flash report, which said, here's the cash we've got in the bank, here's the orders we got today, here's whether or not they're on track. And it kept that in the top of mind of everybody in the company, from the CEO all the way to the guy assembling tillers on the production line. Everybody got that forecast, and it kept everybody pretty well focused. Now, I'm indebted to an author called Philip Campbell, for this forecasting template model that I'm going to share with you and show you how to use. You can develop your own model. You can use this one. A live copy of this spreadsheet is going to be in your chat links. And it forecasts your cash. Now, the whole spreadsheet goes out from January through December. I only used the first 6 months here so that the type was the size it is instead of being half the size. And this example has 4 sections to it. Now here in section 1, it looks a lot like a profitability statement, doesn't it? We've got sales, we've got cost of goods sold, we've got operating expenses, we've got a total expense line, and we've got a bottom line, and we've got a gross profit line. Well, here, there's a couple of things that are a little different. Up at the top there, that top line is not sales, that top line is our cash balance at the start of the month, the start of the period. And then down there where it says EBITDA, that funny looking EBITDA at the bottom, that would normally be labeled net profit, but this is net profit with a twist. EBITDA stands for earnings before interest, taxes, depreciation, and amortization. And it's used, that concept is used as a proxy for operating cash flow by financial analysts who study large corporations. It's useful to us because we've pulled out of it those things that typically are accrued as part of profitability. In other words, we calculate what they are and we use them to measure profitability, but we don't actually pay them. All right. We pay interest every so often. We pay taxes every so often. Depreciation and amortization are paper entries that reflect past non-profitability related entries for things like capital equipment. Okay. But our operating cash flow is pretty much reflected here in section 1. Now, section 1 is about profitability usually. And we just said that cash comes and goes from our business that isn't measured by profitability, isn't measured as part of profitability as the accountants define it. So now we've got sections 2 and 3, which measure those things that aren't really part of profitability. Section 2 talks about debt service, principal and interest payments. Yes, interest is an expense, but until we pay it, it's not part of cash flow, right? So most of us, if we have a business loan, we either have a revolving credit line, and we'll talk about that in a little while, or we have a term loan. And a term loan has level payments over a period of months or years, right? So those level payments include both principal and interest, but we don't care what's principal and what's interest. It's all just cash for this purpose, okay? So I've included a note 1, there's some numbers on there. Note 2 is there, and the other is there for you to use when you forecast your cash flow. And you adjust note 1 to be whatever yours is, of course. Section 3 talks about investments. These are investments in our business, and the commonest one is capital expenditures. When you make a $1,500 or $15,000 investment in a new truck, that's not really part of profitability. It's not measured that way by the accountants, but it is part of cash flow. It's cash leaving your business in exchange for a lump of equipment It could be a truck or a van, a machine, a stamping machine, a drilling machine. All that sort of stuff is capital expenditures, and they get reflected as the cash going out of the business that you see here. So we've accounted for the interest. We've accounted for cash flow from capital expenditures, which gives rise later on to depreciation, right? Section 4 reconciles everything and brings it all together. And this is other cash flow items and timing differences is the heading here. Now, the first thing we're going to do, when we have a goods business, we have something called the cost of goods sold. It's stuff, the value of stuff taken off the shelf and sent to our customers, delivered to our customers. Now, that money was spent maybe months ago, creating and putting on the shelf that piece of inventory. So that's not cash, that's just goods coming off the shelf. So we add back the cost of goods sold and then deduct instead the actual cash that moved out to create the cost of goods to replace that inventory on the shelf. In this case, it's called inventory purchases. And the real inventory purchases numbers in cash, as you can see, are different in this example than the actual cost of goods sold as the accountants would measure it, right? Now, in a manufacturing shop, you might not only have raw material purchases or inventory purchases like this, you might have factory overhead, you might have direct labor as well to put into that line if you account for them in that way in your accounting system. Now, the next thing that happens is sales. We make, many businesses make most of their sales on credit. I'll send you this book today, you send me the money next month, right? That's on credit. But that's not cash flow. So what we measure instead is the cash that we collect from those invoices we sent out a month, 2, 3 ago, right? So we deduct this, we deduct the cash sales for the month, we deduct the credit sales for the month, and we add in cash collected from actual over-the-counter sales and collections on accounts receivable. And you can see there's a difference there, right? Because you'll always have a little bit of a difference between what you sold this month and what people paid you in cash this month based on prior sales and sales across your counter. Now, the next line talks about taxes. Remember, earnings before interest and taxes? We don't pay taxes as in the same way that we accrue them. We might pay them only quarterly. And therefore, we're going to record the tax payments when they're made for cash flow purposes, not when the accountants accrue them. And here you can see we paid $3,000 in January. We paid $2,500 in April as part of our tax bill. Now, the next line is called change in accounts payable, and that could be up or down. If you think about it, a level of accounts payable is the accumulation of our promises to pay in the future for what we've already received today, right? Now, if that level goes down at the end of the month, that means we paid cash and paid it down to a lower level. In this case, in January, we paid it down $500. In March, we let it rise $750, okay? And that change in accounts payable is really a change in available cash because on the one hand, we spent cash to pay down accounts payable. On the other hand, we got goods and services in advance of paying for them. And that gave us, in effect, cash to operate with, in this case, goods and services, all right? So that change in accounts payable is a direct impact on our cash flow. There's a couple of other lines there for you to use or your accountant or bookkeeper to use as you adapt this to your purposes. But the whole point of this is we come down to a total of those cash flows and timing differences, just like we came down to a total for section 1 and section 2 and section 3. Now we take those three pieces, you see the EBITDA there at the bottom, the total debt service and the total investments in sections 2 and 3, and the total of section 4, which is the cash flow items and timing differences. We net those all together. And at the end, we get a change, which is our net cash flow for the month. And you can see that right here where I'm flying the cursor around. For the month of January, we had a positive net cash flow of $905. Now, at the start of January, we had $10,000 in the bank, right? Well, simple addition means that at the end of January, 10,000 plus our net cash flow of 900, we have 10,905 in the bank at the end of the month. And that is what we start February with. Go through the same process, and we end February with $15,605 in the bank. This is a nice example because you got positive cash flow in all the months that you see here. Okay, that won't always be the case with your business, but it's the case right now with this example. Now we keep doing that for every month, all the way through the cash flow. Last month's end, this month's start, this month's end, next month's start, and so forth. And when you're done, you have a 12-month cash flow. Now, what do we do here at the end of February? At the end of February, or the end of January even, we compare what our actual cash flow was to what we forecast it was going to be. Go through each assumption. What was different from the assumption? Why was it different? Was it different enough for a reason that's going to persist into the future, in which case we should now change our assumption for all 12 months? Or is it something that just occurred once? We know why, it's not going to happen again, and our assumption is still good for the future. And that's what you have to do each month. And each month, any revised assumptions get applied throughout your forecast, and you add 1 month out at the end. So at the end of January, you start February, and your forecast adds a January of next year, so that you have a 12-month rolling forecast all the time. Sounds like work. Yes, it is. Still, it's work that needs to be done. You can enlist your bookkeeper or CPA to help you do it, or you can do it yourself. And it gives you information about what's coming in your business, what's going to happen out there. Now, there's a couple more lines on this example that I want to talk about. The first is the minimum cash balance target. Many businesses set a minimum level of cash they want to have in the bank just to cushion you against unexpected shocks. Okay. For some businesses, that's a month's worth of operating cash flow on average. Other businesses, it might be 2 months. Okay. I belong to a car club where the car club board of directors thinks that they need to have a year of operating expenses in their minimum cash balance. A year. To offset any unexpected shocks. All right. And regardless of how you set that number, it's a good idea to set it, because that then gives you an understanding of another layer of understanding of when you're going to have excess cash in the business, or when you're going to have a shortfall in cash that you need to cover somehow. All right. And that's what that bottom line number is, the cash excess or shortfall. Here it all looks pretty rosy, right? Your cash excess continues building nicely. You haven't done anything with it. You haven't paid dividends. You haven't paid yourself as the investor owner, and so forth. But this number gives you an idea. Do I have enough to invest in that new equipment that will expand my business? Do I have enough to make loan prepayments that will cut down the period of time I'm in debt? Do I have enough to pay Uncle Shorty and Cousin Morty the money that I borrowed from them 2 months ago to cover a cash shortfall? All right. All of that is part of this forecasting process, and it gives you information. And the information is used for communication purposes with all your business stakeholders. As I said, Philip Campbell developed this schedule as part of his book called Never Run Out of Cash. He has a website called neverrunoutofcash.com. That website's listed in the resources we're going to provide you here at the end. And you'll be able to go there and get the whole book for free. Yes, he's got some other things he wants to sell you, but the book is free. And it gives you a much more detailed process here for estimating cash, how to make assumptions, what kinds of assumptions are common, and that sort of stuff. And that way you can get started on your cash forecasting experience. Now, after you forecast it, what I say, track it. All your major accounting software these days, and I hope everybody's using some form of computerized accounting software. All the major accounting software lets you create a P&L statement, a balance sheet, and a cash flow statement. All right. Some of them are very much in the format of what we just talked about for forecasting. Some of them are a little different, but they do let you create and track your cash flow as you create an accounting period, right? For most people, that accounting period is a month. For businesses with slower movements, slower but larger transactions, it might be a quarter. If it's an emergency, you might need to be tracking it daily or weekly, all right, to find out what's coming in today, what's going out tomorrow, as opposed to what came in last month, what went out last month, and comparing that to your forecast. In the tiller business I was in the 1980s, as I mentioned, our marketing department would drop marketing promotions. Then they dropped them in the US mail. This is before the internet. And so once they dropped them in the mail, their experience told them that they would start getting orders for things within a certain number of days of dropping that promotion in the mail. And there were several that dropped in the mail during the year, different cycles of part of our general cycle of promotion. And they would then start tracking those orders against what they expected the orders to be daily. And they did it day by day. And we put it as part of our flash report every day and every week. You know, are the orders ahead of schedule? Are they behind schedule? How are they flowing? And everybody was interested in that number because those orders coming in were what kept the company going. Okay. So for your business, it may make sense to track it. If you're expecting a promotion to do something, forecast what that promotion will do, and then track it every day because you can see the orders coming in, all right? Or week, if that's what you need to do. But do it, track it, compare it to your forecast, find out why your track is different from your forecast, and it will be. Trust me, it will be. And then see if you need to revise your cash flow assumptions. Revise those assumptions. Now you've got a new revised forecast that perhaps is a little more reasonable. Notice I didn't say accurate. Nothing you're planning is ever accurate. It's how reasonable it is. Okay. Reasonable to create management decisions on. Now, tactically, once you've forecast it and once you've tracked it, how do you affect it outside the normal course of the business? And everybody wants to get cash flow in. So there's some tactics that you can use to accelerate your cash flow coming in. The first and greatest one is just to sell, sell, sell. Analyze your existing customers and what they've bought. Call them up, talk to them. Don't wait for them to reorder. Be proactive. That's what your sales force is there for. Call them to offer more and related products. And you improve your cash flow by offering them pricing discounts for fast payment or cash with the order or more goods for the same money if they pay cash today. Okay. Notice the whole idea is to get the cash up front with the order or shortly after the order. Okay. Faster than normal. Right. So think about how you would do that with your customers, analyze what they've been buying from you and make them a deal. Now, while I say sell, 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 I also want to emphasize you need to continue your marketing and prospecting. Your existing customers will erode over time. They will fall away. Customers will capture them. They'll get old and retire. They'll die. But your customer base will shrink over time unless you're replacing it with new customers. That's what marketing and prospecting is all about, and you want to continue to do that. We'll talk more about that in a bit. Now, I also tell my clients to concentrate their cash in one bank, because then you have faster availability of your entire cash balance for doing management stuff, investing in your business. Okay? You use that one bank, it brings everything together. Otherwise, if you use multiple banks, it usually takes a night's work, at least, if not two sometimes, to get credit in your bank for transfers from those other banks. It also costs money from time to time to transfer money from those other banks. If you have a cash flow shortfall, because, for example, you're going to buy a new piece of equipment, then you're up there and it's time to borrow money. where you borrow it from is immaterial, but you want to make sure you match what you borrow to what you're using that cash for. If you're borrowing because you had a huge sales month and you put all these invoices out the door, but you've got a lot of expenses that you got to cover, well, that's the kind of thing that lends itself to a revolving line of credit. You can pay it up and down, you pay the interest bill every month, but you can pay it up or draw it down according to its terms with the bank daily, just by calling the bank, right? On the other hand, if you're buying capital equipment that's going to be useful to you over a long period of time, you might take out a term loan. And that term loan is level payment over a period of time. But that equipment is also giving you economic value over that period of time. So you kind of match the two up, you know. So keep in mind that you're accelerating your cash flow in by doing smart things with your existing customers and with your banks. Now, also with your existing customers, you can use professional collection techniques to collect your receivables faster than your customers will just mosey in and pay. And you can do that by building a relationship with your customer through communications. Call them and follow up, okay? When you call them, it's not just about your bill, it's about their business. What do they see happening? How's it going? Are your goods moving through their business the way they would like them to, okay? What can you do to improve your service to them or improve the products they're buying from you? All right, other than cheaper prices. That's not part of this discussion. But you can also evaluate your customers as to when and how they pay you. And for those that pay you more slowly, you can tighten your credit requirements. For example, with a customer, you could reduce their open to buy limit, which forces them to write you a check faster so that they don't exceed that open to buy limit. All right. Because at a certain point, you have to say, you know, I can't afford to do business with you this way. I got to stop shipping you because you haven't paid me. All right, within terms. So you can set your credit limits for your customers, lower or higher. You can also take some of your customers and say, I can't afford to deal with you on credit because you pay too slow. I'll take a credit card with the order. Okay. Or I'll take a company check with the order. In the 90s, I was in a business, a venture funded startup business in the computer industry, hardware industry. And the payment terms for creditors in that industry, they were extending you credit if they gave you a COD company check credit, right? Which means when the goods were delivered, you gave them your company check, which is really about a 3-day credit limit, because by the time the check gets back to them and gets deposited, you've got 5 or 6 or 7 or 8 days of credit that before it hits your bank. That was considered credit in that industry, right? Otherwise, they would only deal with you if you gave them a credit card with your order, and you had a corporate credit card to do that. But communication is the key with your customers. Now, we talked about revolving lines of credit. There's also a process in the short-term credit industry called factoring, where you actually sell the invoice from to your customer to a third party that then collects that invoice from the customer. Now, you get a discount. The third party discounts your invoice to you fairly heavily because they want to make profits and they've got a cost of money themselves. But that's a way to get cash in the door faster. It's a fairly common technique that's used in the fashion industry, where it might be 6 or 7 or 8 months before a customer would pay the supplier for the clothing they'd ordered, for example. Okay, and factoring is a big deal there. You can also, to accelerate your cash in, if it's worthwhile, use a lockbox service. When you use a lockbox service, your customers send their checks to a post office box. That post office box is not collected by your staff or you, it's collected by the bank. And the bank processes it and then sends you all the payment evidence so that you can put it through your system. And this can cut 5 or 6 days off of your cash availability Because if the customers send it to you, and then your accounting department has to process the payment and prepare the deposit, and then deposit the money, and then have that money collected through the banking system, that can take 3 or 4 days. With a lockbox, it's overnight, and your accounting department processes the payment after it's credited at the bank. Okay. And that's, again, it may not be a lot if you're talking about a $5,000 or $6,000 a month business, or a $50,000 or $60,000 a month business, but if you're talking about a 5 or 10 or 20 or 30 or $50 million a month business, that 3 or 4 days worth of float, the value of that float, even at current low interest rates, starts to add up. And so that helps you get the cash in faster, make it available for you to use faster. Now, cash flow out. How do we decelerate cash flow out? That's the whole idea. Deceleration, cash out; acceleration, cash in. Again, we take a look at our vendor file, the same way we looked at our customer file. We prioritize our vendors as to their importance to the business, and then communicate with them as to what we're doing and why we're doing it, and how we want to do business with them. Now, when you analyze your vendor list, you're going to understand that there are a variety of vendors, many of whom are so important to you that you pay on their terms, period. And you just make sure you do that. And that's your first priority for payment, because if they don't ship to you for future goods, then you're out of business, or you don't have anything to sell your customers. And so those vendors are Class A vendors. Now, there's other vendors that you can slow down a little bit on and be a little bit in arrears on from time to time, as long as you catch up once in a while. And those Class B or Class B and C vendors, you pay a little bit more slowly. They may not sell you things that are as vital to your dealing with your customers. Okay. But in all cases, before you start doing this, you want to communicate with your vendors, and you want to tell your story. Here's what our business is like. Here's what's happening. Here's my cash flow forecast. Here's what I've been tracking. And we're finding out that our forecast has some challenges in it for us, and we would like to slow you down by X period of time for some purpose, some period. We want to pay less for a period of time and then catch up. All right. All this takes communication, because when a vendor suddenly sees a good paying customer that suddenly isn't paying well, or just doesn't pay, and they don't have any communication with them, they get really nervous really fast. All right. And they might have an automatic stop shipment feature put into their system for accounts that are more than X days in arrears, unless somebody overrides that. Right. And if you've communicated with them and gotten their agreement for what you want to do, negotiated that agreement for what you want to do, then they change their system and you don't get stopped shipping when you're slightly out of terms. All right. This is important. And I can't emphasize to you how much communication with your vendors and stakeholders is important in making this all work. Now, the other part of decelerating cash out is to cut your operating expenses. Yeah, that's easy for me to say. But if you analyze your expense ledger very carefully, and analyze your payroll very carefully, and look at how you're doing business, you can then begin to make difficult decisions about reducing your expenses. You may wind up just saying, we have to do without this expense, whatever it is, for some period of time or permanently. When you analyze your expense ledger, again, you look for those things that directly impact your ability to provide goods and services to your customers. The other things, to the extent that they don't contribute to that, or that they don't contribute to the immediate well-being and morale of your employees, you have to then say to yourself, do I really need to do these right now, or for some period into the future? Same thing with payroll. I will tell you that from direct experience that it is the most difficult thing in the world for a manager to sit down with a good performing, nice person employee and say, I'm sorry, I don't have a job for you. But you may have to do that so that your business can keep operating. And that's very important. And you have to be very sensitive to the people involved and do everything you can to ease their transition out of your business when it's necessary. Now, also take a look at what your business does and how you do it, and look at where you create the most value for your customer. What part of your business is your customer really paying you to do? They're not really paying you for sales and marketing. They're not really paying you for human resources. They're not really paying you for accounting and finance. They're paying you because you add value somewhere to their operations. And keep that kernel of value added firmly under your control in your business, right? Anything else, almost everything else today can be outsourced from your business. If design is why people buy from you, keep design, outsource everything else. If low manufacturing cost is why people buy from you, keep low manufacturing costs, outsource everything else, right? Those things are all available to be outsourced. There are companies that specialize, that make a business out of that. And you can find them around town if you just look them up on Google, right? Now, finally, I'll come back to this again. Don't eliminate marketing. All too many businesses cut marketing and advertising as their first thing. And when you do that, you disappear from the marketplace. And your competitors, the first thing they will do is call up your customers and say, hey, Thompson Logistics is not advertising. We haven't heard from them. They're not doing any marketing. Have you heard from them lately? Oh, they must be going out of business. And they'll start stealing your customers with that message. Don't eliminate marketing. You might be able to reduce it a little bit, but you must keep visibility in the market to keep your customers knowing that you're there, and to prevent your competitors from stealing them, and to build your customer base as it erodes. You have to continue to market and prospect. All right. So those are some things that you can do for the deceleration in normal times. Now, it's an emergency. It's a pandemic. You're closed. What do? All right. And the first thing that you do is to decelerate even more radically. Now you're beyond the normal course of business. The pandemic is not part of the normal course of business. And you have to take negotiations specifically with your vendors, with your landlord, with your bank. The whole point of these is to delay and catch up. That's the whole concept. If you owe your vendors money, can I delay paying you for 90 days and then catch up over the next 90 to get back in terms? Will you keep shipping me for the next 90 on that basis? Or is there some reduced level of shipment that we can negotiate? Again, communication based on my forecast and my tracking. I have information, I can communicate it to you, and we can negotiate. Same deal with your landlord. Can I delay my rent for the next 3 months and catch up over the balance of the lease, or some shorter period of time? Same thing with the bank. Can I get some forbearance on the next 2 or 3 payments and then make up those payments by making double payments for the months after that, or by catching up over the balance of the term? Can we renegotiate the payment term? Okay. Delay and catch up is the whole idea. You want to accelerate even further. Call your customers, prepaid service contracts with a hook. I'll give you 14 months for the price of 12, pay today. I'll give you 14 months of your subscription, pay today. For the price of 12, pay today. Buy a gift card. I'll honor the gift card later, but you buy it and give me the cash today. If I'm working on contract with people, I'm coming up on a new contract period. Can I negotiate an advance contract payment? Most new contracts, and even some renewing contracts, require you to spend a little bit of money to get that customer aboard, get them set up, get people assigned, get all of that stuff done. And therefore, it's proper and reasonable to ask for an advance payment against the contract that they then pay against during the period of the contract. but it's cash today. Similarly, if you see an emergency coming down the road, disaster and relief loans become a lifeline that you need to take advantage of. And the sooner you see the need coming, the sooner you can get after it, the sooner you can get after applying for them through people and using assistance from your CPA, your accountant, or somebody like NMSBDC. All right. But those are things you do in an emergency. You get outside the normal course of business. You get outside your normal business terms with your customers and your vendors, and you start communicating about how to decelerate your cash out and accelerate your cash in. Now, all the relief programs that have been passed during the pandemic require you to keep records. And it's much easier to keep good records if you stay up to date on your bookkeeping. Bookkeeping results when you take evidences of payment and receipt and enter them into your accounting system. And when you have that and you're doing it on a regular business, once your entries are made, you have then an incentive to properly file the evidences of payment and receipt. They're called documents of original entry that you got that drove your bookkeeping system. That may be automated in some cases. You may have a point of sale system that automatically feeds into your bookkeeping system. But even that point of sale system has some evidence, daily cash totals, register tape totals for the day, things like that, that back up the bookkeeping that was done. There are a lot of relief programs out there, federal, state, city. There are hundreds of billions, literally trillions of dollars that have been appropriated for relief programs during this pandemic. I hope you got your share of them. But what you have to understand is that each of those programs, regardless of what it's called, the Payroll Protection Program, the Economic Injury Disaster Loan Program, the Shuttered Venue Operators Grant Program, the New Mexico Economic Relief Grant Program, the Albuquerque City Economic Development Grant Program, all those programs have specific requirements for what you have to do to A, qualify, B, create evidence that you spent the program money on what the program was for, okay? So each time you do one of these, you have to ask, what is this program for? What do I get to spend the money on? Do I spend the money on that normally anyway? All right. And then you want to be sure that you account for that money in a way that lets you easily go into your accounting system and isolate where that money came into the business and what that money was spent on. That usually involves establishing sub-accounts in your business bookkeeping system's chart of accounts for each loan or each grant. You don't have to establish separate bank accounts for them. That gets confusing after a while, and it also prevents you from bringing your cash together to use it rapidly. What this all does is it prepares your business to be audited, because sure enough, sooner or later, somebody's going to show up from the local office of the feds or the state or the city and say, I'm here to audit your PPP program loan that you applied for grant relief for. I'm here to make sure that you spend it in the right proportions on what you were supposed to spend it on. Show me your books. Not only show me your books, show me beyond your books, show me your payroll records. Show me the lease that you have where you pay against that lease. Show me your utility bills that you paid with the money from this program. You need to keep those invoices, those evidences of payment or receipt, or documents of original entry, as the accountants call them, and keep them so that you can access them quickly and easily to satisfy the auditor. And the quicker and easier you're able to give the auditor what they want, the quicker and easier it is for them to do their job and go away and not bother you anymore while you're focusing on serving your customers. All right. Now, to do that, you want to make sure you're prepared to work with your CPA and or your bookkeeper as to what is to be kept, how it's to be kept, and so forth. Your CPA or your bookkeeper may have very, very specific suggestions to make. Follow those suggestions if they make sense to you. If they don't make sense to you, find out why they're suggesting it that way. because there may be things that they know that you don't. So you want to make sure that your record keeping is as much in order, because having to pay back part of a grant may leave a huge hole in your cash availability. So make sure that what you get is properly accounted for, the records are properly in place. You can provide an auditor quickly and easily with what they want to see, because when you can't do that, the auditor starts to ask for more stuff. Well, do you have this then? Do you have that then? Show me this over here. And eventually they look at more than they should look at, and that may raise additional questions. And you don't want them to raise additional questions. Trust me. Now, this seminar was created out of a lot of resources. Philip Campbell's website, neverrunoutofcash.com, and the book were lay out a detailed approach to taking control of your cash flow. That's on this site. I'm not going to list through all of them, but there's a number of resources here that you can consult for more tips on managing your cash flow. Also, New Mexico has put out a variety of COVID-19 business resources for you to look at, best practices for doing business, coping with COVID, and so forth and so on. And those are there for you to look at as well. As I said, Anna's put a copy of the slides, a link to that in the chat part of the program today. So make sure you copy that out somewhere before the program ends. Also, you can contact SBDC not just through their website at www.nmsbdc.org. You can also call them up at the 2 numbers that are given there. The email info@nmsbdc.org for emailing them. The U.S. Small Business Administration is approachable as well. The phone number there and the email, disaster customer service, both get you to the people who administer the Economic Injury Disaster Loan Program. The website sba.gov also has a lot of resources on it, and some direction and definition and program descriptions for federal programs that might be available to you. So that's 2 different sources for further contact to talk to people. Also, I want to acknowledge Philip Campbell again. He was very, very helpful. He gave us permission to use that template from his book and to share it with you. The National Federation of Independent Businesses, NFIB, publishes a lot of material, some of which went in here. Inc. magazine has a large online archive of business articles and cash flow management articles as well. And then I'd be remiss if I didn't mention the organization I belong to, the SCORE Association's Albuquerque chapter, which partnered with SBDC New Mexico for the creation of this program and some others that you can find on their website. Now, for those of you who have questions, this is the time to bring them forward. I don't see any immediate Q&As in the queue, but I'll take a few seconds and let you think about it for a moment and type in a question and send it back to us. Thanks very much for doing that. It makes me think that you're listening out there. Anna, is there anything else that they should know at this point?
No, I think we're good. Thank you so much for the presentation, and thank you all for joining us. And we'll just hold on here for a moment to see if you have any questions. Oh, it looks like one just popped in here. I'll let you.
You have a recommendation on accounting software. And yes, I do have a recommendation on accounting software, although SCORE does not recommend or get any money by recommending or endorsing any particular software program. There are a number of small business accounting programs on the market. I would bet if you would ask 100 small business people what they use to keep their books, that the majority of them would probably answer QuickBooks. That's probably the widest in use program right now. It's easy to start out with. You can start out with it online. There's also versions of it you can establish on your own local computer and network. It has modular construction so that you can add modules to it as you need them over time. And at its biggest and best, it's a very sophisticated small business accounting software program. There are others. Great Plains makes one. SBC used to make one, but they're more a large company corporation. The simplest, there's a version of Quicken, which is called Quicken for Home and Business, for very, 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 very small businesses. That works pretty well. But the majority of folks work with QuickBooks, and most accountants are prepared to take QuickBook files and work with them in their offices and swap them back and forth by email and stuff. So that's probably your best bet for that would be that program. Jessica thanks us and said thank you very much. Payment processors like PayPal, Stripe, Venmo, Square for online. If you can fit them to the bank that you're using, or arrange an automatic transfer from those banks, that's a good thing. Your bank, approach your bank and see what kinds of credit card processing they offer to you, whether they have a connection with PayPal or Stripe or Venmo. I know PayPal can reach into my bank account and take money out to pay if I ask them to do that. Venmo does the same thing, or charges a credit card. Like the normal way I use PayPal is to charge a credit card from PayPal. Approach your bank, approach the payment processors and ask, and then hook that up if possible. If not, then be prepared to make those transfers manually. I mean, you tell Stripe or Venmo in some fashion to transfer the money to your bank account, or you use your balance in PayPal or Venmo or Square. You use that balance to pay customers directly from that. That's what I would suggest. But again, it's communication that helps make that thing happen, that makes that happen. I hope that answered your question, Giselle. If it didn't, I'd be happy to take a follow-up. But those are the kinds of things I would do. Again, talking to people and getting a hold of somebody in their customer service organization, although that may seem difficult. It may be difficult, but you definitely want to make that contact and ask that question. If that's all the questions we've got, I'll say thank you very much. I appreciate your attention today. We're going to talk about a couple little last things to wrap up here. First of all, what's next? I promised you next steps, and the next steps are up to you, because you can take this information, combine it with some of the resources that were here today, and go home and start building your own cash flow forecast today. We're halfway through September. Actually, we're 2/3 of the way through September, so you could start with October's cash flow. Create your rolling 12 months, start monitoring your cash flow against your assumption, your forecast against your actual experience, and make sure that your assumptions are reasonable. Modify them and keep going forward, but get started now. The sooner you start, the sooner you can see that cash flow shortfall coming at you in the future, and the sooner you can start thinking about how to deal with it. So that's pretty important. I see another question popping up here. Thank you from Giselle. And you're very welcome, Giselle. I appreciate that. But start today. Take your next steps. Use the resources that were here. Use what we talked about, especially the never run out of cash template, and get going. Make it a priority to keep it top of mind and to act on it today. All right. That's what's really important. Now, again, I will mention the SBDC website one final time, nmsbdc.org. They've got other training, business counseling, and loan application assistance. They've got links to a variety of other resources there. It's a very good, useful site for you to look at. And then finally, just an appeal personally, you're going to receive a survey via email after this presentation. That helps me improve what we do. And if you would please, please, please fill that out and send it back. I will thank you in advance for doing that very much. It's very important that we get feedback on how this is being conducted and how we can improve it going forward. So thank you for returning your surveys that you're going to get a little later. And with that, if there's no further questions or needs, I will say that's all, folks, and bring this all to a close. Anna, it's all yours.
Thank you so much. Appreciate it, Tommy. Great information, wonderful presentation, and thank you all for joining us. Have a wonderful day and week ahead, and we'll see you next time.
Bye-bye, everybody.
Bye.